This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
So joining me this week is Nick Galarnik. Great to have you back, bud.
Thanks for having me. It's nice to be back.
All right, so now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to the homepage, MacroVoices.com, and click on the red button over David Rosenberg's picture saying, looking for the downloads. Nick, on page 2, I have the S&P 500. Let's just dive into it. Let's start off with some of your levels, as you always have shared with us in the past.
Yeah, so right now, Patrick, on the S&P, we have an implied move for next Friday's December 20th monthly OPEX of plus minus 80 points, which gives us an implied upside of 6160 and an implied downside of 6,000 on the nose. Given that we've ran pretty hard, I do think that we see perhaps a further push to the upside on a Santa Claus rally. However, beyond that, into mid-January, after the Trump inauguration, I'm getting a bit bearish in that time frame or so.
Well, Nick, there's no denying the prevailing bull trend that's in place. The pattern of higher highs, higher lows has been very much in place. And certainly there's sectors of the market like the Mag 7s that continue to rip higher. The interesting thing here is we have a huge gamma pinning driven by this huge open interest from that JP Morgan whale, which acts like a gravitational pull at these levels. So while we could probably take a couple stabs to the upside, unless the FOMC can kind of break the market out of the orbit of this gamma pinning, then I think that the market has an equal chance of actually just staying stuck at this level throughout the remainder of the year. Typically, that's why we see those low volume and low volatility periods often in the holiday window. And at this stage, it's entirely possible that that could continue to be the story. Now, though, Nick, what I want to talk about, though, is let's look underneath the surface of the S&P 500. And that's on page 3. I have the percentage of stocks on the S&P 500 that are above their 50-day moving averages. Now, for an index that is trading at its all-time high, we have seen the market breadth deteriorate from 70% down to 52%, where basically half of the stocks are actually in a downtrend. The pattern has been persistent all year. We started the year up over 90%. We saw peaks at 85% twice, and the most recent new all-time high on S&P came with only 70% participation. Now, that was on the Republican victory push on the upside. And so what we're seeing is the deterioration of the market breadth, which for a moment looked really good when the financials and other sectors like that were doing well, including the energies, when the Republicans won in November. So, Nick, this is where on page 4, I overlaid the S&P 500 versus the Russell 2000 and the Mag 7.
Yeah, I'm looking at the Mag 7 right now. They are handily outperforming everything else in the market. Like, you look at names like Tesla, for example, which has almost doubled in the last 6 months. Apple's at all-time highs. Google hit all-time highs yesterday, rightfully so. They're the most undervalued in my opinion, and one of my key holdings in my portfolio. Amazon's at all-time highs. Meta's at all-time highs. So everything is outperforming right now in the mega caps. The real problem here is that everything else is lagging, and that includes semiconductors as well, including NVIDIA, which is yet to hit a new all-time high with the rest of the Mag 7s.
Yeah, and that NVIDIA, I think, is an issue because it truly was the general of the bull market up until now. But what is interesting is obviously in November, everyone was very excited about the small cap resurgence. And it's very quick to see how the Russell quickly just came right back in line with the S&P. And I wouldn't say it's worse or better. It's just really not where the money flow is actually occurring. What's interesting is literally in the last week and a half, while these Mag 7s went ripping higher, literally almost parabolic on the upside, we have seen the S&P 500 equal weight index and the Russell both actually systematically selling over those same 6-7 days. And so really now we're seeing almost all of this momentum shift from a broader base to just a handful of stocks. We are already seeing corrections in the financials, in the energy space, all of these which were doing so well a month ago. And the question really then becomes, is this a scenario where by the end of the year, once all of these have exhausted, the Mag 7s have exhausted their upside, which could still be higher, will we see that be the catalyst for a very challenging first quarter of next year? It really feels like it, bud.
Yeah, it really does. And one thing to note too is that with the Nasdaq 100 rebalancing occurring on Friday, we have Apple, for example, is going to increase their weight by about 1%. Palantir's being added by about 0.8%. NVIDIA is going to be increased by about 1% as well. Microsoft, almost 1% too. You have EQIX being added by about 0.5%. A lot of these names are going to be even higher in weighting overall, namely the mega caps, Apple, Microsoft, NVIDIA, Google, Amazon, Tesla. They're all increasing in weight. So that'll actually accentuate the movements of the indices based upon the Mag 7 performance.
100%. So moving on to page 5, I have that NASDAQ percentage of stocks above their 50-day moving averages. Again, a breadth indicator looking now specifically at the NASDAQ stocks. And what's amazing here is that it really shows what has been driving the NASDAQ. And it's really the Mag 7s. Look at, we're at 53% of stocks above their 50-day moving averages on the NASDAQ. More importantly, we have not seen a breakout of this breadth indicator above 60% on a sustained basis almost all year, which basically is that it isn't really a NASDAQ and technology rally. It is really just an AI rally in a few of these Mag 7s that are such market cap behemoths that they're basically running the entire show. The fact that breadth is divergent in this way in itself, I think, is not healthy. What I was originally thinking was going to be something that was very healthy for the market was that on that Republican victory, it felt like the market was widening its breadth. We saw those energy stocks, we saw financials, we saw all these consumer discretionary names and other things all starting to rip to the upside. It was like, okay, well, now we have the backdrop of something that could be bullish because the whole market could participate. That really is dissipated almost in its entirety.
Therein lies the problem as well, right? With the Republican victory, so many names ripped to the upside, and a lot of people don't really factor in that once Trump is in office, they remain bullish on a lot of names too. But the problem is that most of that upside is already priced in based upon the movements we've already seen. And a lot of names have already fallen back down, namely energy stocks that I've noticed as well.
Right. So moving on page 6 and 7, I want to talk about the skew and the implied correlations in the market. But to put them into context, I think we start off just talking about the VIX and where volatility is here. What's your take on this really low vol?
Yeah, Patty. So with the VIX right now at a 14 handle, we're looking at about 0.85% movements intraday, top to bottom. What we're seeing is a lot of this spot up, VIX down, but I think that's going to change after the first month of the year into January. I think we're going to see perhaps some more downside in the broad markets and a correlating spike in the VIX. It seems almost like everyone is very complacent right now and no one's looking at buying insurance because we've seen such a rapid run in the last couple of years. But to me, this is very reminiscent of late 2021 or so, when everyone was very bullish. And then what happened out the gate into 2022, we saw a massive decline on the indices, namely tech stocks, that occurred for the entire year. And I think this is actually a big risk factor going forward, which has me, hedging myself a lot more than I usually do.
It's a good segue to go on to the CBOE skew index on page 6 here. Now, first of all, the VIX is down in the 13 handle. We even temporarily saw it down on the 12 handle, which is not totally out of line. If you look at the daily ranges, even the daily implieds are just so low, and the market volatility has narrowed. The gamma pinning is occurring. When there is a lack of major news and a lack of participants really making big moves during the holiday season, that in itself could mean that these lower volatility period for, let's say, 30 days forward, which is essentially through the holidays, may not be totally out of line. But it really is a bigger question of what is in store for the new year. What's interesting here is that while we are seeing at the money implieds relatively cheap, whether it's the 1 month, 3 month, 6 month, even 1 year implieds, are all on the lower boundaries of their ranges, and buying at the money options is relatively affordable. But when you look at the skew, which is essentially the steepness as you go, let's say, out of the money on insurance and the markets, what you're actually seeing is that the skew is actually up along the top end of its multiple year ranges. And this could be reflection of the very low at the money vol, but at the same time, dealers are not really willing to sell out of the money puts that cheap at this moment. At least the skew is still a little bit on the upper side there. But what's interesting is on page 7 when we look at the implied correlation index from the CBOE, and we're down near 10%. I mean, this thing oscillates obviously from 0 to 100. And so we've seen back in 2000 and 2021 periods where we were up 80% correlation. We're down to the lowest levels. This has obviously been a huge problem for dispersion traders who live off of these kind of correlations. But it also is a reflection on many investors who are individual stock pickers that may be very frustrated with the fact that their basket of stocks isn't performing the same as to the benchmark S&P index, which has obviously been so grossly overweighted, these Mag 7s, which are carrying the index. One way or another, this is a really bizarre market environment with the breadth deteriorating. I think that as for all of the optimism and bullishness and speculation that's going on there, under the hood, the market is nowhere near as healthy as it looks on the surface. And I think that that's got to be a big warning sign for the new year.
Yeah, Patty, I totally agree. Now, moving on to page 8, we have the US dollar index. What are your thoughts here?
Yeah, Nick, this is also super interesting because we are trading now along the 2-year highs of the dollar index. Individual currencies, like for instance, the euro broke its already that range. We saw the US dollar against the Canadian dollar, the CAD break out of these multi-year ranges. So we're already seeing currency movement. With this consolidating as a flagging formation above the moving average, it really feels like at this juncture that we have a dollar that is setting up for a bull breakout. And this is very much in frame with something that could be a risk-off play in the new year. Typically, a U.S. dollar rallying during a period where risk assets are struggling has been something in the macro space that has been evident in the past. And so it'll be really interesting to see whether the dollar breakout starts to happen in the new year and if it lines up with equity weakness.
Now on page 9, we have that gold futures chart, which is now pushing not too far from all-time highs. I do think we push all-time highs quite soon, but what are you thinking here, Patty?
Oh, exactly. Well, look, I was very concerned when we hit 2,800 about the fact that, well, we finished the number of measured moves to the upside, but everyone was so bullish, so optimistic, so leveraged up, and like there was no risk in it. And we had a very quick and fast deleveraging, kind of like catching traders off guard that forced them to cover, created that spike. There was room for there to be 2 waves, what we call a zigzag correction that could have been as deep as 2,500. But my big picture bullishness was always there. It was just a matter of when will this corrective pattern have fully played out and a potential new bull phase begin. Here we are once again, back above the 50-day moving average. We didn't make lower lows during the consolidation for the last couple of weeks. We broke above a very key level around the 2,700 level. And so this is a gold market that might be setting up for a breakout. Now, there's always a risk of, a double top retest and a consolidation along its highs, very similar to what we saw in May earlier in the year. But the backdrop of a bullish gold environment is there. If they can, if the bulls can gain any traction on this, the next measured move to the upside is toward 3,000, and it could very well be in play. Let's see whether or not they can hold it. The key for me is that they need to spend at least the next week continuously supporting all short-term sell-offs towards 2,700. You want to see good accumulation on every dip to show that the next bull phase has begun. Well, Nick, finally, though, I want to just touch on page 10 on the crude oil chart. And this is a chart that has just been stuck in the mud, left for dead. Nobody wants to talk about it. No one cares about it. But here we are at a major support line that has now been tested like 5-6 times. Now, whenever a support line is tested that many times, there's always a risk that it was going to break temporarily to a lower low just to wash out stop losses and other things sitting below. But we've clearly found a fair value zone for oil and a level where there's a balance between buyers and sellers, and it's settling in here. And the question is, does that establish an accumulation pattern that will be the base for what will be a mean reverting oil trade? There's a very large amount of shorts out there, a lot of people that are underweight oil. And so if oil in any way shows sign of life, it could spur a number of traders just putting money there that could see us trade back up to mid to high 70s on just a reaction trade without it even becoming a new bull market. And so there, from an asymmetric perspective, I think there's room to watch oil and what happens here next. Now, Nick, that does it for the charts, but a lot of our listeners have been asking, where did you go? And what I wanted to just share with all of our listeners was that you and I started piloting a new options YouTube show. It's called The Long and Short of It. So we started with the first episode discussing a Google butterfly spread that you came up with that turned out to be quite the banger. And in the last episode, we went deep on why portfolio hedging has rarely been cheaper.
Yeah, Patrick, it's been a pleasure doing that podcast so far with you. Two things to really emphasize on why we're doing this new podcast is one, that MacroVoices focuses more on macroeconomic topics, whereas I'm more of a micro trader. I trade individual names myself. I'm trading on shorter term time frames, and I'm using options predominantly, which we can't really discuss too much in depth over here. And the second thing is that being on YouTube, we can actually visualize the strategies we're talking about in real time so that our listeners can actually follow what we're talking about and see what we're talking about on charts.
No, bang on. You're exactly right. It's so awesome. We can share the screens and talk about all the strategies and show everyone the options chains. It's really cool. Listeners, if you're interested in taking your options education at next level, make sure you tune in on YouTube. All the episodes can be watched on my YouTube channel at Patrick Ceresna. The link's in the Research Roundup email and or on the chart deck.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.